Welcome back to the deep dive. For many of us, taxes, well, they can feel like trying to find your way through a thick fog.
Absolutely. It's dense stuff.
And we're all looking for those clear paths, the ones that actually lead to saving some real money.
Yeah, the meaningful
Well,
savings.
today we're basically paving a superhighway straight to one of the biggest tax-saving opportunities out there for business owners and certain investors.
We're talking about the qualified business income deduction, QBI.
Exactly, QBI.
And look, for individuals, sole proprietors, contractors, even some trusts and estates, this isn't just some small detail. It can be a real game changer.
Mm-hmm.
So our mission today, we're going to unpack it, all the complexities, rule by rule, and we're using the official IRS instructions for Forms 8995 and 8995-A as our guides.
Straight from the source.
Straight from the source. Think of us as your guides, basically lighting up every corner so you can understand how to calculate it, right? And, most importantly, maximize that tax advantage.
Absolutely. By the time we're done here, you, our listener, you should have a really clear roadmap. You'll know what QBI is if you qualify, and crucially, you'll see the key strategies to, well, leverage it for your own finances.
Keep more of your own money. That's the goal.
That's the bottom line. So let's get started. Let's really unpack this thing.
All right.
So to kick things off, let's get that big picture view. What exactly is this QBI deduction we're talking about?
Okay. At its core, it lets eligible taxpayers deduct up to 20% of their net qualified business income. That's income from a trade or business.
20%. That's a pretty hefty chunk right off the top.
Right.
A direct cut to your taxable income.
It is, and it can mean substantial savings. But it's not just your main business income.
Oh, what else is included?
Well, the deduction also covers 20% of qualified REIT dividends, that's real estate investment trust dividends, and also qualified PTP income from publicly traded partnerships.
Okay, REITs and PTPs, those are separate pieces then.
They're distinct components, yeah. Sometimes people overlook them, but they can definitely boost your overall deduction. Adds another layer of potential savings.
Okay, good to know. But there's always a but with taxes, isn't there? There's
Yeah.
a catch, a limitation.
There is, and this one's really critical for planning. Think of it like a speed limit on that superhighway we mentioned.
All right, what's the limit?
Your total QBI deduction, the whole thing, it can't be more than 20% of your taxable income.
Okay.
And here's the really important part. That taxable income is figured before you even apply the QBI deduction. And it's also reduced by any net capital gains, including qualified dividends.
Whoa, okay, so let's say my taxable income is, I don't know, $100,000 before QBI. My deduction can't be more than $20,000, even if my QBI calculation says it should be higher.
Exactly right. That $20,000 is your ceiling in that case. Doesn't matter if your QBI was massive. Understanding that cap is, well, it's one of the very first things you need to factor in when figuring out your actual tax savings potential.
Got it. That sets the stage. So that's the what. Now let's talk about the who. Who actually gets to claim this?
Right. Primarily, we're looking at individuals. That includes sole proprietors, independent contractors, gig workers, and also certain trusts and estates.
Makes sense for people running their own show directly. But what about, say, S corporations or partnerships? They're businesses too. Do they claim the 20%?
Ah, good question. That's a key distinction. S-Corp and partnerships themselves, they don't get the deduction directly.
Oh, okay.
Instead, what they do is crucial. They pass through all the necessary QBI information to the individual shareholders or partners.
So it flows through to the owners.
Exactly. You'll typically see this info broken down on a Schedule K-1 form. That K-1 gives you the numbers you need for your personal tax return to figure out your deduction.
The K-1. Got it.
And it's similar for cooperatives, too. They pass the info to their patrons, usually on a Form 1099 PATR. So the business generates the income, yes, but the deduction itself, always claimed by the individual taxpayer.
Okay, so it really targets the individual owner, even if the income comes through a business structure. What about those trusts and estates you mentioned? You said certain ones. Their taxes can get pretty tangled, right?
They definitely can. For trusts and estates, the QBI calculation is a bit more involved. It gets computed, and then it has to be allocated between the trust or estate itself and its beneficiaries. And that allocation, it's generally based on how the distributable net income, the DNI, is split up for the year, whether it's actually paid out or kept by the trust.
Okay.
If there's no D&I, then all the QBI stuff stays with the estate or trust. And just to add another layer, there are even more specific rules for something called an electing small business trust, an ESBT.
ESPG.
Yeah, they have to do the QBI calculation separately for the S-corp part of their holdings and the non-S-corp part. It just shows, how detailed this can get and maybe why getting specific advice is sometimes a good idea here.
No kidding. Okay, so we know who might be eligible. Now let's talk forms. This sounds like a key decision point, using Form 8995 versus Form 8995A. Why does this choice matter so much for tax savings?
It matters hugely. It's not just picking a form number. It really dictates how complex your calculation will be and what limitations might kick in.
All right, laid out for us Form 8995 first, the simpler one.
Right. Think of 8995 as the express lane on our tax highway. It's designed for taxpayers whose income is below certain thresholds.
Okay, what are those thresholds for, say, 2024?
For 2024, if your taxable income before the QBI deduction is $383,900 or less if you're married filing jointly,
Okay.
or $191,950 or less for all other filing statuses, single, head of household, etc., then you use Form 8995.
That's great news for a lot of people. So below those income levels, you get a simpler calculation. Sounds like an easier path to the tax benefit.
It absolutely is. The big advantage is you generally don't have to wrestle with the more complicated limitations based on W-2 wages or the unadjusted basis of property, the UBIA stuff we'll get into later.
So it streamlines it, makes the deduction much more accessible for those folks.
Exactly. It simplifies the whole process significantly.
But what if your income is higher than those amounts?
Okay, so if your 2024 taxable income before QBI is more than $383,900 married filing jointly, or more than $191,950 for others, or if you happen to be a patron in a specific type of agricultural or horticultural cooperative, then you have to use Form 8995A. This is the more detailed form. The main route, you could say, maybe with a bit more traffic and requiring more careful navigation.
And using 8995A implies more work, more records needed.
Pretty much, yeah. You'll need to fill out additional schedules. You'll potentially face those more complex calculations involving W-2 wages and the UBIA of your business property.
So this is where maximizing the deduction gets trickier.
It is. It definitely demands a more careful approach, digging deeper into your financial data, understanding those extra rules. But, the potential tax savings are still there, and often they're larger because your income is higher. It's a trade-off. More complexity, but potentially bigger savings if you navigate it correctly.
Okay, so the form choice is directly linked to income, and that dictates the complexity. A really critical first step in figuring out your tax saving strategy and what kind of records you need ready.
Precisely. Know your income, know your form.
Okay, we've set the stage.
Yeah.
Who qualifies, which form to use. Now let's dig into the real core of it. What actually is qualified business income, QBI? This is the number your deduction is based on, so getting this right. It's absolutely crucial for tax savings.
It really is the foundation. So at its heart, QBI includes what the IRS calls qualified items of income, gain, deduction, and loss. These have to come from your domestic trades or businesses.
Domestic, so U.S.-based.
Right. And they need to be effectively connected with conducting a U.S. trade or business.
Effectively connected. What does that mean in plain English?
It means the income is directly tied to your active business operations here in the U.S. It's not, say, passive investment income sitting off to the side or income from a business you run entirely overseas.
Gotcha. Active U.S. business.
Exactly. So this covers income from your sole proprietorship, from partnerships, but remember, not those publicly traded partnerships. They have separate rules. We touched on S corporations and also certain states and trusts.
Okay, pretty broad. Covers a lot of common ways people do business.
Yeah.
What about deductions? How do normal business deductions affect QBI? Can they actually help with tax savings here too?
They absolutely do affect it, and yes, understanding this can definitely help optimize savings. QBI is calculated after you take many standard business deductions.
Such as?
Things like unreimbursed partnership expenses, business interest expense, the deductible part of your self-employment tax, your self-employment health insurance deduction, contributions you make to qualified retirement plans like a SEP IRA or a solo 401k, those kinds of things. Now, here's the key point. These deductions, they already reduce your overall taxable income, right? But they also directly reduce the income figure used to calculate your QBI.
Ah, so it's a double impact.
In a way, yes. It means managing these expenses smartly doesn't just lower your overall tax bill, it also directly impacts the base number for your 20% QBI deduction. Finding that right balance with deductions is key.
Great point. So managing deductions influences the QBI base. Now, just as vital as knowing what is QBI is knowing what is not QBI. What's excluded. Getting this wrong could really mess up your deduction.
Critically important. The IRS gives a pretty clear list of exclusions. First off, anything not properly included in your gross income anyway, that's out. And income that isn't effectively connected to a U.S. business, like we said, also excluded.
And I assume regular employee wages are out. Like, my W-2 salary doesn't count as QBI, right? Because I'm an employee, not a business owner in that context.
That's correct, generally. Wage income is excluded. Unless the little statutory employee box is checked over in box 13 on your W-2, that's a narrow exception.
Statutory employee, okay.
And here's a really important kind of tricky detail the IRS watches for. If you used to be an employee somewhere and then you start providing basically the same services back to that same company, maybe as an independent contractor,
Okay.
the IRS presumes for 3 years that you're still essentially acting as an employee for QBI purposes. So that income wouldn't count as QBI.
Wow, a 3-year presumption, even if you have a contractor agreement.
Yes. Now, you can try to rebut that presumption with evidence, but it shows they're looking closely to stop people from just reclassifying wages to get the QBI deduction. That's a huge detail for anyone making that kind of career shift.
Definitely a red flag to be aware of. Okay, what else is definitely not QBI?
Other big ones. Reasonable compensation paid to yourself from an S corporation. That's salary. Not QBI. Guaranteed payments made to partners. Also not QBI. Payments a partner gets for services they provide outside of their partner role. Excluded. Also, anything treated as a capital gain or loss under any part of the tax code is out. Dividends and things that act like dividends, out. Interest income is generally excluded unless it's properly allocable to the trade or business itself.
What's an example of interest that wouldn't be QBI?
Think about a business with extra cash sitting in a savings account, earning interest. That interest usually isn't QBI because it's from investment working capital, not generated directly by the core business activity.
So it has to be income from the active business itself, not just managing the business's money.
Exactly. Also excluded, income, loss, or deductions from things called notional principal contracts. Most annuities, unless they're directly tied to the business. And, importantly, those qualified wheat dividends and qualified PTP income we mentioned earlier.
Yeah.
They are specifically excluded from the definition of QBI itself.
Wait, but you said they're part of the deduction.
They are. But they're calculated separately and then added to the QBI part of the deduction. They don't get mixed into the calculation of your actual business QBI. It's a bit confusing, but they're treated as distinct components of the overall deduction calculation.
Okay, got it. Separate buckets. Wow, that's a lot of specific rules. Feels like you could easily miss something trying to sort through all your income streams. Does the IRS offer any, cheat sheets or tools for this?
They do, actually, and it's really helpful. In the instructions for Form 8995 and 8995A, you can usually find a QBI flowchart.
A flowchart.
Yeah, it's a visual guide.
Yeah.
It walks you through a series of yes-no questions about an item of income, gain, deduction, or loss. Step by step, it helps you figure out if that specific item counts towards your QBI.
That sounds incredibly useful.
Oh, it is. I really recommend you, the listener, find that chart when you're working through your numbers. It can simplify things immensely and help make sure you're accurately calculating your QBI base. Getting that base right is step one to maximizing your savings.
Fantastic tip. Using an official IRS tool like that flowchart seems like a no-brainer to avoid mistakes and headaches. It's like having a little GPS for this complex calculation.
Exactly.
All right, so we've really nailed down what counts as QBI. Now, let's shift focus slightly. What makes a trade or business itself qualified for this deduction? And this ties into something you mentioned earlier that sounds tricky. Specified service trades or businesses, SSTBs. Understanding these definitions feels critical, especially for higher earners or certain professionals.
Yes, this is absolutely crucial territory, especially if you're a service provider. So the general rule is pretty broad. Any domestic trade or business where you're allowed to deduct ordinary and necessary business expenses under Section 162 of the tax code, that can potentially be a qualified trade or business.
Section 162, ordinary and necessary expenses. That's the standard test for most business deductions, right?
It is. The core idea is, are you doing this primarily for income or profit? And are you involved with continuity and regularity? It means you're actively and consistently trying to make money from it, not just, pursuing a hobby now and then. The IRS wants to see a real, ongoing business effort.
So, demonstrating that consistent business purpose. Now, for S Corp or partnerships, where does this qualified trade or business determination happen? At the business level or the owner level?
Good question. It's made at the entity level, at the business level itself. And here's something significant that often trips people up. You don't need to meet the material participation rules under Section 469, the ones that usually limit passive activity losses, to qualify for the QBI deduction.
Really? So even if I'm a passive investor in a partnership, I might still get the QBI deduction based on its income.
That's right. As long as the partnership itself is conducting a qualified trade or business, your share of its QBI could be eligible, even if you're not actively involved day to day. It definitely broadens the pool of who might benefit and offers more paths for tax savings.
That's a huge distinction. Opens it up quite a bit. Now let's talk about something specific many listeners might be wondering about. Rental real estate. Can renting out property count as a qualified trade or business for QBI? This seems like a major opportunity.
Yes, it absolutely can. Owning and renting out real property can definitely be a trade or business if it meets that Section 162 standard continuity, regularity, profit motive.
But just being a landlord might qualify.
It might. And even better for planning, there's something called Revenue Procedure 2019-38. This provides a specific safe harbor.
A safe harbor, meaning if you meet its conditions, you're automatically considered a trade or business for QBI.
Exactly. For example, one key part of the safe harbor involves performing at least 250 hours of rental services per year for the properties grouped in that enterprise. If you meet the safe harbor's requirements, your rental activity will be treated as a trade or business for QBI.
250 hours. That's a concrete number to aim for. What if you don't meet the safe harbor?
Even if you don't hit the safe harbor, your rental activity might still qualify under the general Section 162 rules, just based on the facts and circumstances of your level of activity. And there's another angle. If you rent or license property to another trade or business that you commonly control, meaning you own a significant chunk of both, that rental activity is also treated as a qualified trade or business. Lots of potential for real estate investors here.
That really is a significant tax-saving avenue for property owners.
Yeah.
Turning rental income into QBI-eligible income.
Hmm.
Okay, but there are always exceptions. What types of activities are definitely not qualified trades or businesses?
The main ones are businesses conducted by C corporations. C Corp have their own tax system. Their income doesn't pass through for this deduction. And, like we talked about before, performing services as an employee. Your W-2 job generally isn't a QBI-eligible business.
Got it. C Corp and employees are out. Now, let's tackle the big one. Specified service trades or businesses. SSTBs. This sounds like where things can get really complex, maybe even restrictive for certain high-income professionals. What are SSTBs and why are they such a critical hurdle?
SSTBs are, well, they're basically businesses providing services in certain specific fields. And the key thing is they face very strict limits on the QBI deduction once the owner's taxable income gets above certain levels.
Okay, so it's tied to income levels again. What fields are we talking about?
The IRS gives a pretty detailed list. It includes health services, think doctors, dentists, nurses, veterinarians, physical therapists. But importantly, it generally doesn't include things like running a health club or spa, or maybe developing medical devices. It's about the direct provision of medical services.
So the type of service matters, not just the broad industry. What else is on the SSTB list?
Also on the list, lawyers, paralegals, mediators, accounting CPAs, EAs, tax preparers, actuarial science, performing arts, actors, musicians, directors, public speakers, but generally not the folks who just, say, maintain the equipment or run the broadcast side. Consulting, providing professional advice and counsel, which is pretty broad. It can even include lobbying, but typically not general sales or providing training unless that training is really integral to the main consulting service.
Consulting sounds like it could catch a lot of different advisory roles. What about finance and sports?
Yep. Athletics is on there, athletes, coaches, team managers, but usually not owning the stadium or broadcasting the games. Financial services includes things like wealth management, financial advising, investment banking, raising capital, but generally not standard banking like taking deposits or making loans. Brokerage services, think stockbrokers, but interestingly not real estate agents or insurance brokers. That's a common point of confusion.
Whoa. Good clarification on brokers. What else?
And finally, the list includes investing and investment management and trading or dealing in securities, partnership interests, or commodities.
Wow, that's a very specific, quite long list. Seems aimed right at many traditional professions. But then there's this other category that's sort of catch-all. Any trade or business where the principal asset is the reputation or skill of one or more of its employees or owners. This sounds vague. Where might this apply? Could it trap, say, influencers or creatives?
That reputation or skill clause, it's definitely a nuance. And yes, it's designed to catch situations where someone's personal brand or unique talent is the main driver of the business's value, even if their field isn't explicitly listed.
Can you give some examples?
Sure. Think about a famous chef whose restaurant draws crowds mainly because of their name and reputation, or a well-known author who gets paid large fees for speaking engagements based on their fame. Celebrity endorsements definitely fall under this. You're being paid because of who you are.
Okay, makes sense. Personal brand driving the income.
Also, if you're getting paid for licensing your image, your name, signature, voice, trademark, anything associated with your personal identity, or if you get appearance fees showing up at events, on TV, radio, podcasts, other media.
So this could potentially hit YouTubers, podcasters, social media personalities if their income is tied directly to their personal reputation or skill.
It certainly could. It means just because you're not technically a performing artist or an athlete on that main list, if your business relies heavily on your specific reputation or skill, your income might still be treated as coming from an SSTB. It really broadens the definition to capture that kind of personal service income.
That's a really important point for tax planning in today's economy, where personal brands are huge. Okay, so we know what an SSTB is. Now the crucial part, how does being an SSTB actually affect your QBI deduction? You said it depends on income. This sounds like where strategic income planning becomes vital.
Absolutely vital. It's a tiered system based on your taxable income before the QBI deduction. Let's break down these tiers because they determine if you get a full deduction, a partial one, or none at all from that SSTB.
Okay, tier one, the lowest income level.
Tier 1. At or below the lower threshold. For 2024, if your taxable income is $191,950 or less for singles, or $383,900 or less if married filing jointly, guess what? Your SSTD is treated just like any other qualified trade or business.
No special negative treatment.
None at all in this tier. You get the full potential 20% QBI deduction from that SSTB, no limitations specific to it being an SSTB. This is the best case scenario for an SSTB owner. Simple, straightforward savings.
Wow. So if you're, say, a doctor or lawyer just starting out and your total income is below that threshold, you get the same QBI break as a non-service business. That's pretty significant for smaller practices.
It is. It seems designed to help those smaller professional service businesses get established and benefit from the deduction too.
Okay, makes sense. What's tier two, the middle ground?
Tier 2. Within the phase-in range. This is where it gets complicated, and you need Form 89995A. If your income is above that lower threshold, but not more than $241,950 for singles, or between $383,900 and $483,900 for married filing jointly, you're in the phase-in range.
Phase-in.
Meaning only an applicable percentage of your SSTB's QBI, W-2 wages, and UBIA is treated as qualified. As your income climbs higher within this specific range, the percentage that qualifies gets smaller and smaller. Your deduction is gradually reduced.
So it shrinks as income goes up in this window.
Exactly. You have to do a specific calculation, usually on Schedule A of Form 8995A, to figure out just how much of your SSTB stuff counts. You can still get a partial deduction, still save some tax, but it's definitely not the full amount, and it requires careful calculation.
Right. A sliding scale downwards. It really puts pressure on managing income if you're in or near that range. Okay, then what's tier 3, above the phase-in?
Tier 3, above the upper threshold. If your taxable income is over $241,950 for singles, or over $483,900 for married filing jointly, your SSTB is simply not considered a qualified trade or business at all.
At all. So the deduction from that SSTB is zero.
Zero. No QBI, no W-2 wages, no UBIA from that SSTB counts towards your QBI deduction. It's a complete exclusion. The cliff effect. If you cross that upper income threshold, the QBI benefit from that specific service business disappears entirely.
Ouch. That's a harsh cutoff. Really highlights why high earners and SSTBs need to be extremely aware of their income levels and maybe explore planning strategies.
But wait, Aren't there some de minimis rules? Do these offer any kind of escape hatch for businesses that might otherwise look like SSTBs?
Yes, the de minimis rules. These are important potential escape routes, absolutely. They set thresholds that, if met, can prevent a business from being classified as an SSTB, even if it does perform some of those specified services. This could preserve the full QBI deduction.
Okay, escape hatches sound good. What are the rules? There are three key ones. Rule one, if your business has gross receipts of $25 million or less for the year,
Okay.
and less than 10% of those gross receipts come from activities that would normally be considered SSTB activities,
Uh.
then the entire business is not treated as an SSTB.
10%. So a small amount of SSTB type work won't taint the whole business if your total receipts are under $25 million. Like if a consulting firm does a tiny bit of investment advice on the side.
Exactly. If that investment advice is less than 10% of their total billings and they're under $25 million total, they likely avoid the SSTB classification altogether. It recognizes many businesses have multiple service lines.
That's a really useful rule. What's rule 2?
Rule 2 is for bigger businesses. If
Yeah.
your gross receipts are more than $25 million,
Yeah.
the percentage threshold drops. If less than 5% of those gross receipts come from SSTB activities, then the business is still not considered an SSTB.
So 10% under $25 million, 5% over $25 million. A tighter leash for larger companies, but still an out if the SSTB portion is small enough. Makes sense. And rule 3.
Rule 3 deals with related businesses. It's kind of an anti-abuse rule. If your business provides services or property to an SSTB, and there's 50% or more common ownership between your business and that SSTB,
Okay, like I own both businesses.
right, or you and the same group own large chunks of both, then the portion of your first business's income that comes from providing those services or property to the related SSTB, that portion is treated as if it came from a separate SSTB itself, at least for the common owners.
Whoa. So if I own an IT company, non-SSTB, that mostly serves my law firm, SSTB, the IT income derived from the law firm could be treated as SSTB income.
That's the idea. It stops people from just splitting off essential functions into a separate non-SSTB entity to avoid the limitations when they're really just supporting their own SSTB. Understanding these de minimis rules, both how they can help you avoid SSTD status and how Rule 3 can sometimes create it for related entities, is absolutely critical for proper structuring and maximizing savings.
Wow. It really shows how carefully you need to look at your business structure and income sources. These de minimis rules are like hidden pathways, potentially very beneficial, but you have to know they exist and how to navigate them.
Precisely. They require careful planning.
Okay, let's shift gears now into some more advanced strategies, specifically for folks with multiple businesses or those in the higher income brackets facing limitations. We need to talk about aggregation and then really unpack those W-2 wage and UBIA limitations that kick in with Form 8995-A. These aren't just footnotes, they're potential game changers for optimizing the deduction.
Absolutely. These are powerful tools. Let's start with aggregation. If you own and operate multiple trades or businesses, the IRS allows you, under certain conditions, to choose to group them together or aggregate them. You treat them as a single combined business just for calculating the QBI deduction.
Aggregate them. Why would you want to do that?
The main reason is to overcome those W-2 wage and UBIA limitations we keep mentioning. Imagine you have two small businesses. Neither one, on its own, pays enough W-2 wages or has enough qualified property, UBIA, to support the full QBI deduction calculated for its income, especially if your overall income is high.
Right, each one is limited individually.
But if you can aggregate them, you get to combine their QBI, their W-2 wages, and their UBIA. Suddenly, the combined pool of wages or property might be large enough to support the full deduction for the combined QBI. It lets you leverage the strengths across your different operations.
That sounds incredibly useful. Like if I have a small retail shop with low wages but decent QBI, and also a rental property with no wages but high UBIA, maybe together they unlock a bigger deduction.
That's exactly the kind of scenario where aggregation can be powerful. But, and it's a big but, there are very strict requirements you have to meet.
Okay, what are the hoops you have to jump through?
First, the ownership test. The same person, or the same group of people, must own 50% or more of each business being aggregated, directly or indirectly, for most of the tax year.
50% common ownership. Got it.
Second, all the businesses you want to aggregate must have the same tax year end. Can't combine a calendar year business with a fiscal year one.
Makes sense. Same reporting period.
Third, and this is a huge GE one we need to stress, none of the businesses being aggregated can be an SSTB.
Whoa, wait. None. Not even one. even if that SSTB qualified for a partial deduction on its own because income was in the phase-in range.
Correct. For aggregation purposes, SSTBs are generally out. If a business is classified as an SSTD, you typically cannot include it in an aggregated group with non-SSTB businesses. This is a major restriction on the strategy.
Okay, that's critical. No SSTBs in the aggregated group. What else?
Finally, the businesses must show they are actually connected economically. You have to meet at least 2 out of 3 specific factors. 1, they provide products, property, or services that are the same or are typically offered together. 2, they share facilities or significant centralized business functions. Think shared office space, employees, accounting, IT systems, HR, legal. 3, they are operated in coordination with or rely on one another. Maybe one supplies the other, or they share customers, that kind of thing.
So it's not enough just to own them. They need to have some real operational synergy or connection.
Exactly. You need to demonstrate that connection. If you meet all these tests, you can elect to aggregate.
And once you aggregate, what's the impact on the calculation?
You combine everything, the QBI, the W-2 wages, the UBIA from all the businesses in the group before applying the limitations. You calculate the limit based on the combined totals.
And you have to stick with it.
Yes, consistency is key. Once you aggregate, you generally have to keep aggregating those same businesses every year, unless there's a significant change in facts and circumstances that disqualifies them. You also have to formally report the aggregation on Schedule B of Form 8995A each year.
What if you don't report it properly?
If you fail to disclose it, the IRS can essentially break up your aggregation, recalculate your deduction for each business separately, and that could mean you owe more tax. So it's powerful, but requires precision and consistency.
Definitely sounds like a strategy needing careful planning and execution.
Yeah.
Okay, so that's aggregation. Now let's pivot to those limitations themselves. The W-2 wage and UBIA limitations. These are the big hurdles for higher income folks using Form 8995A. Remind us when they apply and how the formula works.
Right. These limitations kick in if your taxable income before QBI is over that lower threshold again, $191,950 single, $383,900 married, filing jointly for 2024. If you're above that, then for each qualified trade or business or each aggregated group, the QBI component of your deduction gets capped.
Capped based on.
It's capped at the greater of 2 amounts. Amount 1.50% of the W-2 wages properly allocable to the QBI from that business. Or amount 2, 25% of those W-2 wages plus 2.5% of the unadjusted basis immediately after acquisition, UBIA, of qualified property from that business.
The greater of 50% of wages or 25% of wages plus 2.5% of property basis. You calculate both, pick the bigger number, and that's your limit for that specific business's QBI deduction component.
Precisely. This formula really drives home the point. To get the maximum QBI deduction when your income is higher, your business needs to either pay significant W-2 wages to employees or have substantial investment in qualified depreciable property, or both.
It directly incentivizes employment or capital investment. Let's break down W-2 wages for this purpose. What exactly counts? Is it just the number in Box 1 of the W-2?
It's generally related to Box 1 or Box 5, Medicare wages, but it's more specific than just grabbing that number. It includes wages paid to employees for services, plus elective deferrals like 401k contributions. However, payments to the statutory employees we mentioned earlier, where Box 13 is checked, typically do not count as W-2 wages for this limitation.
Okay, no statutory employees. And the wages have to be linked to the QBI.
Absolutely. They must be properly allocated to the trade or business that actually generated the QBI. You can't just count all wages paid by a taxpayer if they have multiple businesses or non-business activities. Only the wages tied to the specific QBI stream generating the potential deduction count towards its limit.
Allocation is key. How do you figure out the exact W-2 wage amount? Are there specific IRS methods?
Yes, the IRS provides 3 approved methods: the unmodified box method, the modified box 1 method, and the tracking wages method.
3 methods. Why so many?
They offer flexibility based on your situation. The unmodified box method is simplest, often using the lesser of Box 1 or Box 5 amounts. The modified Box 1 method adjusts Box 1 for certain items and adds back deferrals. The tracking wages method is the most precise. It tracks wages subject to federal income tax withholding plus deferrals. It's often required in complex situations like short tax years or if you bought or sold the business mid-year.
So the tracking method is most accurate, but maybe more work.
Generally, yes. While simpler methods might work for straightforward cases, the tracking method ensures the most accurate allocation, especially when timing or business changes are involved. Choosing the right method or using the required one is crucial for getting the limitation calculation correct.
Another layer requiring careful attention. Okay, let's tackle the other piece of the limitation formula. UBIA, unadjusted basis, immediately after acquisition of qualified property. What kind of property counts, and what does UBIA really mean?
UBIA is basically the property's original cost basis on the day you first placed it in service for the business. We're talking about tangible property, stuff you can touch, like buildings, machinery, equipment, furniture.
So not land. Land isn't depreciable.
Correct. Land doesn't count. It has to be tangible property that is subject to depreciation under Section 167, and it must be held and actively used to produce QBI. Plus, its depreciable period must not have ended yet.
Depreciable period. How long is that for UBIA purposes?
It's the later of 10 years after the property was first placed in service, or are the last day of its normal statutory recovery period used for depreciation, like the 5, 7, 15, 27.5, or 39-year periods. So older assets eventually fall off the UBIA calculation.
Wow.
You need relatively current investments in depreciable assets to keep boosting this part of the limit.
So a building I bought 15 years ago might still count, but maybe some equipment I bought 12 years ago has already passed its 10-year UBIA window.
Could be, depending on its specific recovery period. You have to check both the 10-year rule and the asset's depreciation life. What about improvements? If I put a new roof on that building, good question. Improvements made to qualified property are treated as separate pieces of qualified property, each getting its own placed in service date and its own UBIA based on the cost of the improvement.
Okay, so improvements add to the potential UBIA pool. What about tricky acquisitions, like trading properties in a 1031 exchange, or getting property from insurance after a fire, an involuntary conversion?
There are special rules for those. Generally, in things like 1031 like-kind exchanges or 1033 involuntary conversions, the replacement property keeps the same placed in service date and carries over the UBIA from the old property. If you paid extra cash, boot, in the exchange, that extra basis is treated as a new piece of property with its own date and UBIA. Similar principles apply when property comes into a business through non-taxable transfers, like contributing assets to form a corporation under Section 351. The idea is generally to preserve the UBIA history through these transactions.
That's helpful. It means restructuring or upgrading assets doesn't necessarily wipe out your UBIA base. Now, is there anything to stop someone from buying a big asset on December 30th just to pump up their UBIA for the year, then selling it in January?
Ah, yes. The IRS anticipated that too. There's an anti-abuse rule. Generally, property acquired within 60 days of the year end and then disposed of within 120 days of the end of that same year, with that being used in the business for at least 45 days during that period. That property is usually not considered qualified property for UBIO.
Gotcha. So quick flips at year-end just for the tax benefit won't work. It really emphasizes that managing both W-2 wages and UBIA is critical for higher-income folks on Form 8995A. They directly gate how much QBI deduction you can actually claim.
Absolutely. They are the gatekeepers for maximizing the deduction in those higher income tiers. Meticulous records and strategic planning around hiring and capital investment become really important.
Okay, we've covered a ton of ground. Let's get into some final but really important scenarios and mechanics. This includes that other 20% piece, the REIT dividends and PTP income, and crucially, how business losses work with QBI, including carryforwards. Understanding these is key to the whole picture.
Right, let's tie up these loose ends. First, that other 20% part of the deduction. Remember, the total QBI deduction is your business QBI component, subject to limits, plus 20% of qualified REIT dividends and qualified PTP income.
So what exactly are qualified REIT dividends again?
These are dividends you get from a real estate investment trust, provided you've held the REIT shares for more than 45 days. They're specifically not capital gain dividends or the usual qualified dividends that get lower tax rates. You'll typically see this amount reported specifically in Box 5 of your Form 1099 DIV. It can also include certain dividends passed through from mutual funds, RICs, that invested in REITs.
Okay, Box 5 on the 1099 DIV. That's a clear place to look. And qualified PTP income.
That's your share of income, gain, deduction, and loss from a publicly traded partnership, but only if that PTP is not treated like a corporation for tax purposes. It can also include gain or loss when you sell your PTP interest, as long as it's not capital gain or loss.
And do the SSTB rules apply to PTP income too? If the PTP itself is in, say, financial services?
Yes, they do. Just like with regular QBI, if the PTP operates in a specified service trade or business, the income you receive from it might be limited or even fully excluded from the PTP component of your QBI deduction, depending on your overall taxable income level. The same income thresholds and phase-outs apply.
So even investment-type income from PTPs isn't immune to SSTB limits for high earners. Good to know. Now let's talk losses. Businesses don't always make money. How do qualified business losses affect the QBI calculation? Is this a potential tax saver over time?
It absolutely is through loss netting and carry forwards. If you have one business with QBI, say $100,000, and another business with a qualified business loss of, say, $30,000, you don't just calculate the deduction on the $100,000.
You have to net them first.
Exactly. You have to offset the QBI from the profitable business with the loss from the unprofitable one. In that example, your net QBI for calculating the deduction would be $70,000. 100 okay, 30K. This loss netting happens first, potentially across multiple businesses, and it's done proportionally if you have multiple winners and losers. It's all calculated on Schedule C of Form 8995A.
Okay, so losses reduce current year QBI. What if the losses are bigger than the QBI? What if you have an overall net qualified business loss for the year after netting everything?
Great question. If your combined QBI from all sources, after netting, is negative in overall qualified business loss, you don't get a QBI deduction in the current year. Instead, that net loss amount gets carried forward to the next tax year.
Carried forward to do what?
To offset positive QBI in that future year. So a loss this year can reduce your QBI and therefore your QBI deduction next year or even further out. And this carry forward happens even if the business that created the original loss doesn't exist anymore.
That's a really valuable feature. It means those losses aren't just wasted. They retain their power to reduce taxes in future years. It's a significant long-term tax-saving mechanism.
It really is. It smooths out the ups and downs of business cycles for QBI purposes.
Does this QBI loss carry forward mess with other loss rules? Like, does it affect my net operating loss NOL calculation?
No, that's an important point. The QBI loss carry forward under Section 199A is tracked separately. It does not affect the calculation or deductibility of that loss for other purposes like NOLs, basis limits, at-risk rules, etc. It's purely for determining your QBI deduction in future years.
Okay, separate tracking, that makes sense. Now, this sounds like it could get complicated, especially if you have losses that are also limited by other rules, like passive activity loss rules or basis limitations. You mentioned a QBI loss tracking worksheet. Why is that so helpful?
Ah, yes, the worksheet. It's incredibly useful because many business losses might be calculated for tax purposes but then get suspended, meaning you can't actually deduct them yet because of other limitations in the tax code. Think passive loss limits, at-risk rules, basis limits, or those newer excess business loss rules.
Right, so the loss exists, but you can't use it yet.
Exactly, and because you couldn't deduct it yet, it wouldn't have reduced your QBI in the year it was incurred, since QBI tracks taxable income items. The QBI loss tracking worksheet helps you keep track of the QBI portion of those suspended losses.
So you know how much QBI potential is locked up in those suspended losses.
Precisely. When those suspensions are eventually lifted in a future year and you finally get to deduct that loss for regular tax purposes, the worksheet helps you determine how much of that now allowed loss should be treated as a negative QBI adjustment in that future year.
Ah, so it ensures that when the loss finally hits your return, it also correctly reduces your QBI for deduction calculation purposes in that year. How does the worksheet actually function?
It's pretty systematic. It uses a FIFO, first in, first out method. You track each suspended loss from the year it occurred. You note its total amount and, crucially, what percentage of it was considered QBI eligible back when it happened, the QBI fixed percentage.
Okay.
Then, each year, as parts of those old suspended losses become deductible, the worksheet helps you apply that original QBI percentage to figure out how much QBI, usually negative QBI, gets released along with the allowed loss. It has columns to track total suspended amounts, the QBI percentage, how much gets allowed each year, and the running balances of suspended QBI and non-QBI loss amounts. It ensures the loss keeps its QBI character while suspended.
Wow. That sounds incredibly detailed, but absolutely necessary if you have those kinds of complex multi-year loss situations. It prevents you from losing track of the QBI impact of those suspended losses.
It's a vital tool for accuracy in those complex cases, directly helping you get the right deduction over time.
Okay, nearly there. Just a few final coordination points. How does the QBI deduction interact with other big parts of the tax code? Does it create or increase a net operating loss?
Generally, no. The QBI deduction itself does not create or increase an NOL. It reduces taxable income, but usually not below zero for NOL purposes. However, those excess business losses under Section 461, which are treated as NOL carryforwards, those are taken into account for QBI purposes in the year they are eventually deducted.
Okay, so it doesn't create NOLs, but interacts with excess business loss carryforwards. What about other taxes? Does it reduce my self-employment tax? Or the net investment income tax?
This is critical. No. The QBI deduction does not reduce your net earnings from self-employment when you're calculating self-employment tax, Social Security, and Medicare. And it does not reduce your net investment income when calculating the 3.8% net investment income tax.
So the savings are purely on your regular income tax liability.
That's right. It's a deduction against income tax, not these other specific taxes. It's important to understand exactly where the benefit applies.
Very clear. And you mentioned Puerto Rico briefly.
Yes, just quickly. For QBI purposes, the U.S. generally includes Puerto Rico. So if you have a business operating there, its income might be QBI. And importantly, W-2 wages paid for services performed in Puerto Rico can potentially be included in your W-2 wage calculation for the limitation, which could help support a larger deduction.
Good to know for anyone with ties there. All right, this has been an amazing, incredibly detailed journey through the QBI deduction. It's obviously powerful, but wow, the details matter. Let's try to boil this down into some key action steps for you, the listener, to really take control and maximize this deduction.
Absolutely. Let's summarize the strategy. First step, always know your income thresholds. This is job number one. You below or above that $191,950 single, $383,900 married threshold for 2024. That answer dictates your form, 8995 versus 8995A, and the complexity you're facing. It's your starting point for saving strategy.
The absolute fork in the road. Know which path you're taking. Step 2.
Identify your business type. Is it a qualified trade or business? Does your rental real estate activity rise to the level of a trade or business, maybe meeting the safe harbor? And critically, could it be considered an SSTB, a specified service trade or business? Nail down these classifications.
Because that SSTB label changes everything if your income is higher.
Exactly. Which leads to step 3. If you do have an SSTB, engage in SSTB income planning. Know which income tier you're in: full deduction, phase out, or zero deduction. If you're near a threshold, can strategic moves like maximizing retirement contributions or timing expenses shift you into a better tier? This is active tax planning territory.
Smart. Thinking ahead about income levels, what's next for those with multiple businesses?
If you have multiple qualified businesses, and importantly, they are not SSTBs, then explore strategic aggregation. Can grouping them help you clear those W-2 wage or UBIA hurdles? Combining resources via aggregation can unlock deductions that wouldn't be possible otherwise. But remember those strict rules: common ownership, same tax year, non-SSTB, and economic linkage.
Aggregation. Powerful, but precise. Okay, what underpins all of this?
What underpins all tax savings? Meticulous record keeping. It's non-negotiable for QBI. You need crystal clear, organized records for all your QBI components: income, gains, deductions, losses. You need solid proof of your W-2 wages paid and allocated. And you need detailed records supporting the UBIA of your qualified property, including purchase dates and costs. Without proof, the deduction is at risk.
Records, records, records. The foundation, and for those with losses.
If you have those complex suspended losses from other tax rules, track suspended losses religiously. Use that QBI loss tracking worksheet or a similar system. Don't let the QBI component of those losses fall through the cracks when they finally become deductible years later. That's leaving money on the table.
Capture those future benefits. Good advice. And finally,
don't forget to leverage IRS resources. The official instructions for Form 8995 and 8995A are your ultimate guide. We've hit the highlights based on them today, but they have the full detail. And that QBI flowchart, use it. These resources are there to help you get it right.
Excellent. So to wrap up, the qualified business income deduction, it's clearly more than just a line item. It's a major opportunity for self-employed folks and pass-through owners to significantly reduce their tax burden.
It really is. And understanding these rules, as complex as they can be, isn't just about filling out forms correctly. It's about empowering yourself with the knowledge to make strategic decisions, optimize your finances, and ultimately keep more of the money you work so hard to earn.
Well said. It truly recognizes the economic engine that these businesses represent.
Indeed. And maybe a final thought for you to consider. The QBI deduction is a clear signal from the tax code incentivizing certain types of business activity and structure. How might a really deep understanding of this incentive, beyond just this year's filing, influence how you think about structuring your business, managing your income streams, investing in assets, or even planning for growth in the years ahead? Could optimizing for QBI actually shape your future business strategy?
Something definitely worth mulling over as you plan not just your taxes, but your business's future. Thanks for taking this deep dive with us today.
My pleasure.
We'll catch you next time on The Deep Dive.